This is Rod Kusin and Spooman for Risk for Tuesday, November 9th, 2010, all times on the Charter Central Standard Time. Our premium strategy is being featured once again, and we're going to talk about various features of that strategy. To begin with, we're going to talk about the underlying indicator that is on the chart. Right now, we have a pop-up window that's giving us information about the calculated bias, but let's talk about the indicator to begin with. When we go to this indicator, it's a very versatile indicator that can tell us a variety of different things. We have it set up here primarily, though, to simply tell us whether the stochastic on a large contract 15-tick interval is positive or negative. If the bars are colored yellow, the stochastic is still going down. If they're green, the stochastic is going up. So that tells us a little bit about the trend using this specific tick bar interval. As the market opened and it continued to move down, we had no trades until this low at roughly 846. We had the strategy set up to test for our pivot setting as well as our divergence setting. We did not get a pivot trade as we moved down. Instead, we got a divergence. We got a divergent trade. The strategy in this case, here's our divergence setting. It's very simple. We just set use divergence set to true. We elect a certain tick bar interval for the stochastic and an overbought oversold range. This is somewhat dependent upon the individual trader's selection, but this is the overbought and oversold range that we used. And there's nothing else set up in here other than to check for divergence based upon our rules. Now we look at divergence in this case based upon what we see in the premium. The premium is the mainstay of this strategy. The strategy reads the premium and various characteristics of the premium, compares them to what's happening with the Spoos, and the premium then basically gives us the reason for taking a trade. The strategy in this case was just set up to take a profit at 8 ticks. But now let's take a look at a different strategy. This strategy had slightly different settings, but it also was a divergent strategy. In this case, we used a slightly larger overbought, oversold range. Instead of 1090, it was 2080, and we combined that with both an SPC 5 as well as an SPC 10. Both of those hit at the same time, and off we went with our long trade there at the bottom. Our trend strategy also picked up trades off of this move. Now, being that the stochastic had already turned, here we're using an SPC 15, which had already turned. We looked again for certain characteristics off of the premium using our trend setting. And the trend setting oftentimes will begin to trade after the pivot. However, because the stochastic had already turned, it manages to pull off a very nice long trade right at the same point where the divergence strategy took its trade. But in addition to that, we got long trades here and then a little bit later on over here. The initial trade was set up to take a profit at 20 ticks. And that worked out quite nicely. So at the beginning of the day, we did not get our pivot strategy firing off a long signal, but we did get divergence using a variety of different settings, and the trend, which is our third setting, also picked up long trades off of this move. Now let's go back to the divergence setting and talk about another set of trades that were fired off later on in the morning. Here's our initial battery of long trades, and as you see, we had no other long trades until the market dropped off and we got long trades right in here. I want to explain something to you about the strategy and why we had long trades right in here but nowhere else. I'm going to draw a horizontal line right in here. Let's go back to the beginning of the day. Now, once we took these trades here, the strategy records the price of the low, and basically we can't get another divergent trade unless the Spoos drop below that price. As we know, the market rallied up and then began to short, and it wasn't until later on, after the noon hour, that we finally dropped below that original price, and we had long trades showing up again here based upon the premium and divergence. Now take a close look at the screen here. These trades ultimately got stopped out. Now let's talk about what these green dots are. These green dots show up on the screen based upon certain characteristics of the premium. When they show up, they indicate that the market has reversed on the trade and there is a potential to take a loss on that move. When these green dots show up, these are our warning indicators. When these warning indicators plot in a situation where the trade is already gone negative, it is a good idea to exit the trade. Don't allow the market to continue to move against you. Just exit the trade. You're already negative. No reason to let it go any further. So there, if a person had a stop that was lower than that, it would be a good idea to simply exit the trade. Don't wait to get stopped out by a protective stop that's below where this dot appears. No reason at all. So that's what that was about. Now, other than that, there were no other divergent trades using these settings until we move into the last half hour. And here we have a few more long trades that are good for a few ticks. Now let's look at another set of divergent trades using a slightly different setting. Again, here's our divergence field, and here we were using a 20/80 overbought oversold range on two stochastics, both large contracts, one with a 5-tick and the other a 10-tick interval. That setting pulled off these long trades just before 11 o'clock. Now you notice, for example, there's that green dot again. Green dot's indicating market's moving against us. So best to get out of that trade. And ultimately, the market does move a little bit lower before it begins to rally up. Now that hit the profit target, but that's the only green dot that you see here. That's the only warning signal. So while it did make its way back up to the profit target, caution would have suggested getting out before that occurred. Now let's go to this point here. This is now 13:45 in the afternoon, and that same strategy now nails the top of this move with some nice short trades, all of which hit their profit target. Then we get another buy at the bottom here, and some buy signals just showing up here before the close. This is all based upon our divergence setting. This screen, we're now looking at our pivot setting. Our pivot setting uses the Prem average field, our buy low, sell high condition field, as well as stochastics, allowing us to isolate where we want the trade to take place based upon specific overbought and oversold ranges. Here we're using a 3 and a 10 tick large contract. These settings also nail this pivot at the high. And we had divergence up there as well, but this allowed us trades for trades based upon the pivot setting. It picked up a long trade here, moved up to that profit target, the retracement line. Additional long trades here that moved up nicely, but really didn't go very far. Here again, we're getting long trades here, but the market is still selling off, and so you see how the green dots are showing up. Those green dots are showing up due to the fact that there are still market conditions that are indicating that the premium is moving against us. So we have to be very careful about holding that kind of a trade. Now ultimately we can expect this to turn and move back up, but whether that's going to occur at this specific moment or not remains to be seen. Now, in the last part of our video, we're going to discuss the use of the trend indicator, or pardon me, the trend setting. Now here, the trend setting again is designed for the purpose of getting us into the move after the pivot or after divergence takes place. So up here, for example, would have been an ideal place to get in on the short. But having failed that, the trend indicator will now pick up specific opportunities to get in on that move. It's reading the premium along with a stochastic on a large contract set to 15 ticks. And as long as that's negative, it's going to pull trades in specific instances where the premium gives us a good entry. Now we see these trades made money, but now the stochastic has turned. We're getting green bars. We want to be out of that trade. Let's look at another example. We have all sorts of short trades taking place in here based on the same premise. 15 tick large contract in conjunction with the premium now gives us opportunities to enter that move down until we finally get out down here with these long trades that have just showed up. So all of those trades wound up hitting their profit target. And there's a nice little equity curve. And we actually have a curve this time. Okay. All right, so that's our video for today. And this is Rod Kusin and Spooman for Risk.